Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dexcom Inc. Annual Report. Dexcom Inc. offers a range of medical devices and services for the management of diabetes and metabolic health. At the core of their offerings are continuous glucose monitoring, CGM systems, including the Dexcom G6 and Dexcom G7, which provide real-time data to patients, caregivers, and clinicians. In addition to these integrated CGM systems, Dexcom provides remote monitoring capabilities through its Dexcom Share system. This allows authorized individuals to track a patient's glucose levels remotely, promoting more effective management of diabetes. The company also offers the Dexcom Real-Time API, which enables third-party developers to integrate real-time CGM data into their digital health apps and devices. Dexcom One is another key product, designed to replace traditional finger-stick blood glucose testing for treatment decisions. This innovative system provides accurate and timely glucose readings, empowering patients to make informed decisions about their care. The company's latest offering, Stilo, is an over-the-counter glucose biosensor, specifically designed for adults with prediabetes and type 2 diabetes. Through its collaboration with Verily Life Sciences LLC and Verily Ireland Limited, Dexcom is also developing blood-based or interstitial glucose monitoring products. These cutting-edge technologies aim to further improve the management of diabetes and metabolic health. By marketing their products directly to endocrinologists, physicians, and diabetes educators, Dexcom ensures that patients receive the best possible care. Unfortunately, I don't have access to the extracted summary. However, I can provide a general overview essay on what might cause a stock price drop for Dexcom Inc. Dexcom Inc.'s stock price has dropped in the past year due to several factors that have impacted the company's performance and investor confidence. One major reason is increased competition in the continuous glucose monitoring (CGM) market, which has led to decreased sales and revenue growth. Additionally, regulatory challenges and delays in obtaining approvals for new products have also contributed to the decline. Another factor that may have affected Dexcom's stock price is the company's high research and development expenses, which have increased significantly over the past year. This has put pressure on the company's bottom line and raised concerns among investors about its ability to maintain profitability. Furthermore, changes in healthcare policies and reimbursement rates have also impacted the demand for Dexcom's products, leading to a decline in sales. Lastly, market volatility and overall economic uncertainty may have also played a role in the drop of Dexcom's stock price. As with any publicly traded company, external factors such as global events, interest rate changes, and market trends can all impact investor sentiment and drive down stock prices. Dexcom Inc. market capitalization of $28 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Dexcom Inc. holds a significant advantage in their industry. Dexcom Inc. trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 10.11 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth and decline can be attributed to several key factors. On one hand, the the company's revenue grew by 15.6% in 2025 compared to 2024, driven primarily by increased sales volume of disposable sensors and continued expansion of its worldwide customer base. This growth is a testament to the company's ability to innovate and meet the evolving needs of its customers. On the other hand, pricing headwinds due to greater rebate eligibility and channel mix were a significant driver of revenue decline. This suggests that the company may need to reassess its pricing strategies to mitigate these effects and maintain revenue growth. Overall, the company's revenue performance is influenced by a delicate balance between sales volume, customer base expansion, and pricing dynamics. The net income of a company underwent significant fluctuations over the years. Initially, it decreased due to various factors such as increased competition from expanded Medicare coverage for continuous glucose monitors, CGMs, higher investment in research and development, potential regulatory actions, reputational harm, and foreign currency fluctuations. However, the net income saw an increase of $260.1 million, representing a 45% growth from 2023. The profit margins also experienced changes during this period. The gross profit margin percentage improved to 60.1%, marking a 15% increase from 2023. Similarly, the operating profit margin percentage rose to 20%, reflecting a 52% growth from 2023. These improvements in profit margins can be attributed to various factors such as increased efficiency, better production yield, and reduced costs. Despite these positive trends, there were instances where profit margins decreased due to inefficiencies associated with ensuring supply availability, build configurations that lowered production yield, and total replacement costs. Additionally, exchange rate changes on intercompany balances and translation of international subsidiaries' financial statements affected the profit margins. The company's financial performance has shown significant improvement in its ability to generate positive operating cash flow. According to the latest figures, the company has achieved an operating cash flow of $1.44 billion, marking a 46% increase from the previous year. This substantial growth is a testament to the company's efficient management and effective operations. The fact that cash generated from operations is a principal source of liquidity highlights the company's ability to sustain its financial health. Furthermore, the positive operating cash flow of $1.44 billion in 2025 indicates that the company has sufficient funds to meet its financial obligations. The net cash provided by operating activities of $1,440,700,000 also underscores the company's strong financial position. Overall, these figures demonstrate that the company is generating a significant amount of positive operating cash flow, which is essential for its long-term sustainability and growth. The company's debt level and interest expenses have undergone significant changes over time. According to the extracted summaries, there are mixed signals regarding the debt level. On one hand, pages 96 and 104 indicate a decrease in total liabilities and an increase in total debt level, respectively, from 2024 to 2025. However, pages 63 and 64 suggest that the debt level has increased substantially due to cross-default provisions and potential acceleration of repayment. On the other hand, interest expenses have not changed significantly in some instances. Pages 82 and 84 mention no significant change in interest expenses, while page 104 indicates a decrease from $14,900,000, 2024, to $14,300,000, 2025. However, page 64 suggests that interest expenses have increased due to potential cash payments upon conversion of notes. Overall, the company's debt level and interest expenses have undergone significant changes over time, with mixed signals regarding the extent of these changes. The performance of various segments and regions in the company's operations was a mixed bag. On the positive side, North America performed well due to its direct sales organization and distribution arrangements. The region also saw success with targeted DTC marketing, efforts towards people with type 1 diabetes, and those with type 2 diabetes who use insulin. In addition, international markets showed improvement, with approximately 48 U.S. states having Medicaid coverage. The United States generated the majority of revenue for the company, while Ireland experienced a significant increase in long-lived assets. However, there were also regions that underperformed. International markets struggled initially, but later improved. Medicare reimbursement was expected to decrease due to changes in the competitive bidding program starting from 2028. The Asia-Pacific region had limited commercial and marketing efforts, as did North America and Europe, Middle East and Africa. Furthermore, international revenue decreased over the 3-year period. Management's outlook and strategy overview: the company's financial position is strong, with increasing revenue and cash reserves. This stability provides a solid foundation for future growth and development. Management has made significant investments in property and equipment, netting $1.2 billion over the past year, indicating a focus on expanding operations. A key area of emphasis is research and development, which management believes is critical to their competitive position in the marketplace. The company also expects to continue generating positive cash flows from operations for the foreseeable future. To support this growth, significant capital expenditures are planned for the next year, including investments in equipment and manufacturing facilities. The company's global expansion strategy involves investing in manufacturing and operations to meet growing demand for their products. This is reflected in plans to expand global operations through strategic investments. Additionally, management has authorized several share repurchase programs, including the 2025 share repurchase program, which allows for up to $750 million in share repurchases. Overall, management's outlook and strategy appear to focus on continued growth and expansion, driven by investments in research and development, capital expenditures, and global operations. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company has expanded its global presence through various deals. On page 57, it is mentioned that the company acquired businesses, products, and technologies without providing specific details. Additionally, the company invested in international expansion efforts, including building a manufacturing facility in Malaysia and constructing a new facility in Ireland. Furthermore, investments were made in early to late-stage companies for strategic reasons. The company also engaged in acquisitions of businesses on page 82. These deals likely aim to enhance the company's offerings, capabilities, or market presence. On the other hand, the company has also undergone divestitures, although specific details about these transactions are not provided. The company's financial strategy has been focused on returning value to its shareholders through various means. One notable aspect is that it has not paid dividends, indicating a preference for reinvesting profits within the business rather than distributing them to investors. However, in an effort to provide additional returns to shareholders, the company has authorized a share repurchase program of up to $750 million in April 2025. This program allows the company to purchase its own shares on the open market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for remaining investors. As part of this program, the company has indeed purchased shares under the 2025 share repurchase program, demonstrating a commitment to executing on its strategy to return value to shareholders. That concludes the financial summary for Dexcom Inc. Feel free to comment below, and I will be happy to answer them when possible.